You might think that filing taxes gets easier once you're ready to leave the working world behind, but in some ways retirement can actually make your tax forms even more difficult. The good news is that you become eligible for a number of tax breaks when you retire. Make sure you're saving all the money you can while you're enjoying your post-retirement life with these helpful tax tips. Standardized deduction bonus. Individuals over the age of 65 are eligible for an additional standardized deduction allowance of $1,550 for single retirees or $1,250 for qualified widows and widowers. If you're used to itemizing your deductions, it might be worth taking the standardized deduction if it can save you a little extra money. Elderly and disabled credit. Once you reach the age of 65, you become eligible for the elderly and disabled tax credit, but only if your income is below a certain level. For single retirees, up to $5,000 can be claimed with this credit, while married couples can claim $7,500. You might also be eligible if you collect disability income, even if you're under 65. Diversify your retirement income. Retired individuals often draw income from numerous sources, including Social Security, tax-deferred savings accounts, rentals, capital gains, and dividends, all of which have different implications in determining your tax rate. Diversifying your potential income sources before retirement will provide you with more options for reducing your taxable income when you finally retire. Remember to pay estimated taxes. Most employees in the United States have estimated income taxes withheld from their paychecks, but no employer is there to withhold your taxes in retirement. It's up to you to pay your estimated tax bill every quarter. If you don't make the payments, you could be charged a penalty, so pay close attention to your income to make sure you're not shortchanging the government. Social Security benefit tax. The bad news about Social Security benefits is that you may have to pay income tax on them, but usually only if you're earning significant income from other sources. The good news is that you only pay taxes on a maximum of 85% of those benefits, no matter how much you're earning otherwise. Individual retirement accounts. Contributions to traditional individual retirement accounts, IRAs, are often tax-deductible, but not everyone knows they can contribute an extra $1,000 a year to their IRA as a catch-up measure when they're over the age of 50, even if they've already retired. What is a 401k? Many employees in the United States have a company-based 401k, which is a retirement savings plan that usually invests in an assortment of low-risk mutual funds, stocks, and bonds. Contributions to the plan are normally split between employees and employers and, similar to IRAs, you can be charged a penalty if you withdraw from a 401k before retirement. Traditional IRAs versus Roth IRAs. When you're setting up your individual retirement accounts, IRAs, it pays to know the difference between traditional and Roth IRAs. Contributions to your traditional IRA are tax-deferred, meaning that you pay taxes when you withdraw from the account but not when you invest. In contrast, Roth IRA contributions are not deductible, which means that withdrawals are not taxed. Traditional IRA to Roth IRA conversion. If you expect to pay a higher tax rate in future years, it might be beneficial to convert your traditional IRA savings to Roth IRA savings. Unlike traditional IRAs, taxes on Roth IRAs are not deferred, meaning that you can take advantage of a lower tax rate when you make contributions to it. One-time IRA to HSA rollover. Individuals are allowed to transfer money from their individual retirement accounts to a tax-free health savings account, but only once. This one-time rollover does not count toward your income, nor will you be charged a penalty for early withdrawal. This transfer could come in handy after you retire, but make sure you do it before you've enrolled in Medicare. Higher filing threshold. This year, single U.S. residents who make less than $10,350 don't have to file a tax return, but that threshold is $1,550 higher for individuals over 65. This can come in handy, and help avoid a lot of number crunching headaches, for seniors who have stopped working and live with their children. No penalty on IRA withdrawals. Once you reach the age of 59 and 1/2, you can withdraw money from your IRA without paying a 10% penalty. Even if you're not yet retired, you can take advantage of this rule. If you withdraw from an after-tax retirement account, like a Roth IRA, you can do so without adding to your income tax burden. Reduced capital gains tax. One benefit of retiring is that it will probably put you in a lower tax bracket. Individuals in the highest tax bracket pay 20% in long-term capital gains tax, while most middle-class U.S. residents pay 15%. If you're in the lowest two tax brackets, however, you don't have to pay any capital gains tax at all. Sale of residence tax exclusion. If you and your spouse are a couple of empty nesters looking to downsize, or you just want to cash in on a house that has appreciated in value, the sale of residence tax exclusion means you won't pay capital gains tax on $500,000 of your profit, or $250,000 for a single filer. Tax bracket planning. You can organize your retirement savings and income to reduce the amount of tax you pay over the long term. Different savings accounts and types of income are taxed in different ways, so you can limit the total amount of taxes you pay by withdrawing limited amounts from traditional IRAs and 401k during your retirement. Required minimum distributions. Once you reach the age of 70 and 1/2 years, you are obligated to withdraw a required minimum distribution, RMD, from your IRAs. Failure to withdraw your RMD leaves you open to a whopping 50% penalty. Only withdraw the minimum amount if you don't need the cash, as you are required to pay tax on traditional IRA distributions. Keep your 401k if you defer retirement. When you reach 70 and 1/2 years of age, you will be required to make minimum distributions from your 401k as well as your IRAs. However, you may be exempt from those distributions if you're still working at that age. In fact, you can even continue to contribute to the plan until you've stopped working. Minimize mortgage payments. One way to lower your required minimum distributions, and thus your taxable income, is to finish paying your mortgage before you retire. Monthly mortgage payments can take a big chunk out of your tax-deferred retirement savings, so think about finding ways to pay it off before you hang up your spurs. Transfer directly from IRA to charity. If you're over the age of 70 and 1/2, you can transfer cash directly from your IRA to a qualified charity and avoid paying taxes on the withdrawal, as donations are generally non-taxable. These transfers can also count toward your required minimum distribution, meaning that you can avoid paying taxes on your IRA withdrawals altogether if you do it right. Realizing capital losses to offset gains. If you've lost money through an investment made with a taxable account, like a traditional IRA or an annuity, you can use those losses to offset the gains you may have made with another investment. You can also roll those losses into future years if you expect to make gains later on in your retirement,